Hi everyone, and welcome to another episode of the HeelanHub podcast, the show for small business owners. I'm Dan Heelan, and on today's show, it is just me talking to you about the budget 2025. Firstly, for listeners that listen to these, a lot of apologies for the small extra delay in the show. I've been croaky and under the weather, so it's been difficult to record, but we have just come off the back of a budget. We did a live YouTube on our main YouTube channel at Heelan Associates and talked for 2 hours. Snivelled all the way through it, but we were joined by over 1,000 people over the time to talk and sort of interact and talk about all the topics we're going to talk to on today's show. So that was really awesome to see. So if that's one of you, thanks very much for attending. It's cool. And I think we'll get only better at doing that, or maybe we'll do it for more things. I think the Q&A sections we had in there were quite appreciated, and we enjoyed doing them as well. So if you're listening to this after the budget, that video is still on our main YouTube channel. So if you go there, you can watch it. It is 2 hours long, so you might want to just look at the first half an hour for some Q&A, or the end part of it to get our main reaction and recap really on there. But by the time you've listened to this, you're going to know everything you need to know about the budget. So in this one, as always, with budget shows, I'm talking mainly about what's the impact of small business owners in the UK. So that's owner-managed small businesses. Whether that's you being a sole trader, a partnership, a limited company, there's something for you in here. If you're not a business owner, there's still going to be stuff that we're talking about, but I suspect you wouldn't be listening to this unless you're a business owner or one of those people that want to be a business owner. So let's get into it. So this budget was really weird in that there was a massive leak just before the budget. The OBR, the Office of Budget Responsibility, leaked a document on their website. So a lot of people already had knowledge going into the budget of what was happening. So that was one of the weird quirks from it. Now, when we was in the YouTube live, I didn't want to look at it. I thought it was a bit like a soap or spoilers. I didn't want to see them. You know, I've don't know how many of these over the years where I've sat and watched films, or I've sat and watched a soap or a series with my wife, and she's gone straight to the web to find out what happens, and I can't stand it. I want to find out for myself. So I actually watched it live. But since then, of course, I've gone through all the different documents and really tried to understand it, because often what they talk about in the actual speech in that small amount of time doesn't fully cover all of the issues. So I've dug out some gold that you may or may not have known from just following the headlines and the speech. So that was a really weird thing that happened. Generally, I think that it was a really rowdy speech. If you've ever watched the budget speech, there is a lot of noise in that room, but it was particularly bad this time. There was lots of interruptions and sitting down and standing back up and giving it another go. And actually, when the opposition, the Conservative leader Kemi, got to come back, that was very fiery, is probably the best thing. So if you haven't seen it, go and watch it. It's quite interesting, I think, and whether you enjoy politics or not, I think it's just a fun thing to do sometimes. And of course, they have very real impact on us as business owners. So that's what happens. And the speech came, and then they're trying to keep this to once a year, which I'm kind of pleased with, because the uncertainty of this particular budget is probably more than I've ever seen in certainly my working lifetime. There was a lot of doom and gloom, and what tends to happen, and from sources that I trust, they say this comes direct from government, is things are leaked to, say, the Financial Times and some of the other publications, and then they do the rounds in the news. And I think half the time they just look at the reaction and see if they can get away with it. Because I did a rumour roundup on YouTube just talking about, you know, what we're seeing in the news and everything else, and just seeing what people are saying, what we could see. And that sometimes feels like a weird thing to do. I don't normally get involved with rumours, but with the budget, some of them quite often turn out to be true. And actually in this budget, about half of the rumours I talked about, in some sort of version of it, turned out to be true. So it is important to follow. So there was all that going on as well. So you do have to keep an eye on it and find out. But of course, it was doom and gloom. Everybody was worried, and it created a really bad period of uncertainty for a lot of business owners. Certainly in the conversations we were having with our business owner clients, they're all wondering what they should do, and it's like it was hard to say. And quite often when these things come in, they immediately change the law or try and sort of backdate them so that you can't do any crazy things before a certain date. Not always though, not always, but certainly that's been the running trend in the last few budgets that we've had. So then, the biggest rumour that was out there was they're going to change income tax. But in their manifesto, the document that they say this is what we're going to do when we're elected, it said they would not change those headline rates of income tax, VAT and national insurance. So it was rumoured they were going to do it. They were going to increase by 2% on our personal tax rates and then decrease 2% in our national insurance rates. It didn't happen. What they did do is they froze, if we use the right English, froze the thresholds for our personal allowances and our higher rate, when we start paying higher rate tax, things like that, for many, many years. So if you imagine at the moment, I call it the tax stack, but if you imagine it like an axis, you have almost like a chart. Up the left-hand side, you've got all your income levels. The first 12.5-ish is normally tax-free, and then you go up to the 50,000-ish line, and that's when you start paying your high rate of tax. So if you're in employment or you're self-employed, that's normally a 20% tax. When it turns into 40%, those thresholds are all staying the same. So as wages increase, more and more people get dragged into that. And as an economy, you can see all the studies if you're interested, that has a really big tax grab effect. So that's one of the headlines has been talking about those. Now, the biggest thing that will impact people is dividend tax. So if you're a limited company owner, chances are you get paid by dividends because they're tax efficient generally. Over the years, more and more tax has been added to dividends. And again, they've added another 2%. Now, it's 2% for basic and higher rate. So what it'll do at the moment is you pay 8.75% in your dividends in your basic rate. And then that bit that goes over 50,000, you end up paying 33.75. So it's pretty big. What's that? Both those rates are going plus 2%. So it'll be 10.75 and 35.75. They're not touching the top additional rate one. They're leaving that alone, which, considering how high our rate is, it's nearly 40% anyway. It would have seemed silly to put it in. So anyway, they haven't changed that. But for all of us limited company owners, it's a big deal. 2%, if you work it out on the kind of dividends you do, it's going to be quite a chunk of cash. And also because of the way the payment on account system works, where you're normally paying tax in advance as well, they're all affected as well. So there's a knock-on effect. So not great. And again, for anybody who doesn't know, you're already taxed on this money. As an owner of a limited company, it's really your money. You've got the limited companies already paid corporation tax at 19 to 25%, and then what's coming out is now being taxed even more. So very nasty. Easy political, though, unfortunately. I think politically it's very, very easy to change those rates. So that wasn't a surprise to see it. And the think tank rumour was that they wanted to change it to 16.5%. So at 10.75%, you could argue it got off lightly from where they wanted to go. But there we go. Now, the other one that is really going to hurt is if you're a landlord. So property income is now going to have its own sort of tax rate. It already doesn't pay national insurance. So what they did is they put 2% extra. So you're going to be taxed at 22%, 42% or 47%, depending on where your earnings lie. This one's really painful because most people who own a buy-to-let property with a mortgage will know there's not actually that much cash in the deal. Everybody thinks landlords are super rich. They probably are if they've not got a mortgage, but most landlords that we come across in our world have a buy-to-let mortgage. They've already been slammed by the mortgage interest. And because of the way the taxation system works, we only get to knock... You do get relief on the interest, but if you start paying higher rates of tax, it's not enough. You can quite often, a couple of property landlords will quite often just not have the cash they need to pay all the tax bills at the end of the year. So increasing that tax bill even more is not good. And the only thing that's going to happen is rents are going to go up in all reality. So that's not, I don't think, a particularly pro-growth change, but that's where we are. And they've done the same. They've changed interest. So if you're a saver and you've got quite a chunk of interest that's coming to you, your 20 or 40% tax is now 22% or 42% tax or 47% tax. You still get savings allowance for some of it. So again, they were at pains to say that for most taxpayers, I think it was about 74% from memory, will still pay no tax on that interest because of the savings allowance. But still, there's a lot of people that will pay that. So again, if you can see, if you're one of those people that's got a bit of property income because you've got a single property, maybe you've got a couple of properties, you're getting dividends from somewhere and you're getting interest and you're trying to live on those investments, then you're hit from all fronts. And many business owners are in this space where maybe they've had a bit of success, so they're already paying high dividend rates. Now that's increased. And then on top of this, we've then got this problem that, maybe we've invested in a bit of property ourselves and now we've got even more tax on that. So yeah, really, really painful time if you're in that situation. Now, talking of limited company owners, the corporation tax hasn't changed. So it's still between 19 and 25%. So that's good. They did say they had committed to this corporate roadmap. And on the roadmap, they said they weren't going to change the main rates. But bearing in mind, they were considering tearing up their manifesto, it wouldn't have surprised us to see more corporation tax rises. But they didn't. They kept it where it is. What is changing is there's some relief to what's known as capital allowances. Now, capital allowances is the thing, is when you buy like big stuff. Like, I'm talking to you now on a MacBook and a microphone and there's a camera involved and all that. Those things would have had capital allowances claimed on them to get good relief for the business when they buy them. Because these things last for many years, normally the way the rules work is that it will be spread out over many years, and they spread it out using something called writing down allowance. Now at the minute there's an allowance that lets you offset the cost of these items for most people in year one, so you don't really use writing down allowance. But there are things like cars that can't have these other allowances that need to be written down over time, and they're reducing the amount. So instead of being 18%, it's now 14%. So some cars are actually far less. There's so many rules, I'm not going to go into it in this show, but let's just say that if you've got a car, the tax relief on it is going to take a lot longer. That's probably the most common example where you're going to see this be a problem. They are introducing a new 40% first year allowance. Again, most small businesses just aren't going to utilize this. So for you, just know that that's happened. So that's happened, but outside of that, corporation tax itself is pretty much been left alone. So that's where we are on that. And of course, I should say that writing down allowance isn't just for corporation tax. That does apply for some sole traders. It's just for many of you, you'll be using something known as a cash basis, and you probably don't get involved with it too much. But that is there. But for limited companies, the corporation tax is staying the same. You've just got this dividend tax problem if you're taking out dividends. Now, the biggest one that I think impacts most people, if you're a small business owner who employs somebody or they're looking to employ somebody, this was just released the day before the budget. But the minimum wages are going up yet again, and this is a real problem. Now, usual bias, I'm an employer, I employ 40 odd people, this stings, but I work with a lot of business owner clients who are in this park where they're employers. And if you think about retail, so I always pick cafes, because cafes and coffee shops are some of the toughest businesses that we work with in terms of can they make any money and survive. And they employ a lot of people around the minimum wages quite frequently because they're quite often part-time, maybe they're young. Now, what's happened is the rates have been hiked again, and the biggest hike is in the 18 to 20 bracket. So an 18 to 20-year-old now costs £10.85 an hour. Now, if you take the rate that was at the beginning of 2024 and look at what's happening by the time we get to March 26, that rate has increased nearly 45%. It's crazy, isn't it? 45%, that rate. And that's going to put real pressure on businesses in this space. Because if you think about it, you've got that, and then anybody over 21, if we did the same comparison, we took what you were paying in 24, and then what you're going to pay in sort of like March, April time, 26, that over 21 age team member, with the changes that happened in the budget with employers' national insurance and things, for many businesses, will cost that business nearly £500 a month more for the same person. So for a small business where in a certain situation for an over 21, if you take your 2024 version of that employee and take your 2026 April 26 version, that's nearly $6,000 a year more for that one person. So imagine you're a coffee shop and you've got a couple of people in there. You know, if you've got some of these people, you might be paying over £1,000 or more, £1,000 a month more for that one person. And there's only so many cups of coffee you can sell, or so many sort of lunches and breakfasts that you can sell to make that money up. And we're going to talk about business rates in a minute as well, and that's increasing. So it's real problem. And of course, what do? Yeah, okay, you can change your pricing. It all ends up costing everybody more. Inflation goes up. But there's only so much the public will be willing to pay for a coffee. And there are these massive giants that do the volume that can afford to keep the prices low, and then it forces all the small businesses out. So for me, this is a real problem. And it was talked about in the budget, in and around the budget. The unemployment rate is the highest it's been for many years, and this is a massive contributor to it. I can tell you, small businesses employ a lot of people, and they just cannot afford to do it. I saw a really good post about apprentices and young people, and a lot of this resonated with me. It's quite often when you've got a young person post, you'll hire two people on the presumption that one of them is not going to like it, or you're not going to like them. And what I mean by that is, at 18 to 20, nobody really knows what they're doing. They don't know if they're going to enjoy their job. So, but you need somebody in that position. You can't afford to hire them, find out 3, 4, 5 months later they don't like it and they leave, or they don't really like work and they don't want to turn up, and then you have to make that decision for them. So you normally hire for 2. You now can't do that. And you're relatively close. It's not that much difference to then hiring somebody with a bit more experience. So I really worry for young people, and I'm a big believer in young people in employment. I mean, we're a big believer in apprenticeships here. We've always got a couple on the go. It's been we won't stop doing it, but it makes it a lot harder. But then we're a slightly bigger business than many of the clients we work with, who are maybe looking for their first couple of employees. And it's crazy, You're looking at an over 21-year-old costing you, with all the add-on costs of employment, pensions and employers' NI, if you get no relief against it, you're talking like $27,500. It's a lot of money to go from zero to a person, So real big. So for small businesses, to me, this is still the biggest problem for a growing small business, is having your hand forced. And again, I think most people listening to this podcast will get this, but when I talk about this on social media, I always get a lot of, I don't say hate, but a lot of comments where people say, well, businesses should be able to afford to pay people more than the minimums. It's like, but they can't. That's generally the maths of it. Take the coffee shop example I showed you. You would agree with me if we actually sat down and went through the details. You would agree with me that it's very, very difficult for them to be paying big money to people to do this. And if the rates are being forced on you, it's difficult. And then say then you've got somebody who's 50, 60p an hour more because they've got a bit more responsibility. Maybe they're a supervisor. Take the over 21 living wage. That's gone up 50p an hour. So you've eroded the band for the person above as well. So then you've got to reassess what you pay the person above. And has this massive, massive knock-on effect. Unreal. So again, that over 21 person versus the 2024 version of them is about 22% more expensive. It's not as stark as an 18 to 20, but like I can tell you, in the world I live in, accountancy wages in the last 5 years on average have jumped something like 35 to 40%, and pricing has not moved to that level. It's a real problem, and we're as a service-based business, we're not immune to this the same as everybody else who works with people, basically. So big one, and I know for some of you that won't be where you're at the minute, but if you're looking to grow your business, that's going to be you. Now, a bit of good news I would say is the self-employed people out there. So if you're self-employed, you don't employ a team, or you're a partnership, you don't employ a team. I feel like the budget is like this big battlefield, and there's all these bullets and this shrapnel and these bombs flying, and you're just kind of just strolling through smiling, and you walk out the other end and think, that was all right, wasn't it? Like, nothing got changed. Nothing really got changed. There are a couple of side things you could argue got changed, but basically nothing. So your national insurance is still one of the best out there, if not the best. Thinking about it, probably is the best. And your tax rates didn't change. So, okay, your allowances got frozen, but out of everybody, that's still the best. And at the moment, if you took a limited company and a sole trader, a self-employed person, and put them up against each other, quite a lot of income levels, the sole trader technically on paper wins out. Of course, limited companies are still great in the right circumstances. We've done a lot of content on this. You'll know I talk on this all the time. It's just that, but self-employment, from a tax point of view, if you take it versus an employee, is very good still. Very good. So bear that in mind. The self-employed people and general partnerships worked out quite well still, as well as anybody else, right? Now, the other things that were happening when we talk about employment costs, sorry, I got excited about the self-employed, so just go back a step, is pension salary sacrifice. Now, you might think, snore fest, what do I want to know about this? But it's important because a lot of bigger businesses use this, and what happens is you say to your employer, I'm going to give 10 grand up, because let's say I'm getting in a rate where I'm going to start losing my personal allowance because I'm earning over 100 grand, or I'm going to lose my tax-free childcare, and that's really important to me. You might say, I'm going to give up 10 grand of my wages. It actually saves me money, and tax and national insurance saves the employer national insurance. It works out really well, and the employer takes that 10 grand and puts it all in your pension. That's salary sacrifice in a nutshell. They're capping that, so you can only do the first £2,000 per person, which is all that's going to happen is, again, the cost of employment is going to go up. I suspect the wage growth will be a struggle, and it's going to cost everybody more money again. So I don't really understand that one, particularly because it's all retirement planning, isn't it, which people want to encourage. Normally the government want to encourage that. So really surprised, but they've got to raise tax from around the edges, and that's what they've chosen to do. I'm not totally wedded to that one. I mean, I work with a lot of business owners and directors of limited companies, and this is an important point. Don't use salary sacrifice. They just pay into their pot normally by employers' contributions. That's not being changed. That's not been affected. You can still pay into your pension that way if that's you. But so it doesn't massively affect a lot of the world that we live in, but I can see the damage it would do to a bigger business that utilizes this with its people, and for the individuals as well, because individuals might then have their gross pay bumped back up and lose a lot of benefits, not necessarily benefits, but like tax-free childcare top-ups and stuff like this, which, they will rely on. If you've ever put kids in childcare, you know how expensive that one is. Now, on top of that, we also had some VAT and customs duty changes. So the big one, because this was asked a lot on YouTube, VAT registration thresholds are not moving. They're staying the same. It's still £90,000 in a 12-month rolling window. It has not changed. But there are interesting, buried in the document, there was a few changes. So mandatory e-invoice filing. So from April 2029, all business-to-business and business-to-government VAT transactions, invoices, have got to use a new e-invoicing standard. Now, I've seen some of this in the making through various connections I've got, and I think other countries, I want to say like Australia and New Zealand already have this, like it's done elsewhere in the world, but there are more details coming on a roadmap they're going to publish during 26. But it's it's just a case of, I think, just being in some accounting software, inevitably these accounting softwares will just sort this out for you. If you're in, not that any of you are probably running Uber, but if you were, there was talk about VAT on taxis, and at the minute, Uber have done their best. They started off in this position where they're like, nope, there's no VAT because reasons. That got tackled. And then they're at this point where they're using something called the tour operators margin scheme to pay as little VAT as possible. Looks like the government are basically just changing it so that they can't do that. So that's probably the easiest way to explain it simply. And from the 2nd of January 26, they're going to be paying VAT, same as everybody else, which is good if you're trying to compete with them for sure. If you're also trying to compete with abroad products coming in from abroad, at the minute, if the product comes in at £135 or less, or they say it is, they don't pay any customs duty. Now, competitively, that's a difficult thing. If it's coming in cheap, that's going to be removed from March 29, so quite a while away. But it should help with some of the competitive issues of cheap goods coming in. So, and it sounds like Europe and other countries are looking to do this as well. So it's going to work both ways. But regardless, I also think it probably stops some of the admin that's happening there. Now, I did say I would mention about business rates. So for those of you with premises, whether you pay business rates it can be binary. If you're, for example, you're in a building that's under, say, 12 grand a year, what they call rateable value. So they look at it and say, oh, it's only worth about 12 grand a year rent. That's not technically the thing, but that's how it feels, right? Then you could have small business rates relief and pay no rates. I remember being there in a tiny little unit and it was great. No one paid it. Like the unit we're in now, we pay in excess of 25 grand a year just to sit here for no other reason. We still pay service charges for our own bins and our own maintenance and all the rest of it, but we also have to pay this sort of tax. Now, business rates, using our coffee shop example, are absolutely crippling to the people involved. And what's happening is, at the moment, since COVID, there's been a relief that says that you would get a discount to your bill. At the minute, the discount's about 40%. And the way the bill works is you take the rateable value and you times it by what they call a multiplier. And that gives you your bill. And then at the minute, there's a discount applied. The discount's due to end. So the government is spinning it like this. It's a really cool thing. They're going to lower business rates because they're lowering the multiplier. So they are lowering it, but they're taking the discount away. And they're also revaluing a lot of properties from April 26. So I think the net result of this is going to be absolutely, I'm sure, I would almost bet money on it, that for a lot of small businesses that we deal with, those business rates are just going to go up. They're just going to go up. They are. If you're in the retail, hospitality and leisure, which is the ones we're talking about being, I think, mostly affected by these pay rises that they're being forced upon, they're also going to have this. So very, very concerned for bricks and mortar. And small business, bricks and mortar particularly. So business rates, keep an eye on that if that's you. Now, another sort of summarising the other notable changes that are in there. I don't think anybody probably listening to this is running an online gambling business, but if you did, remote gaming duties jumped from 21 to 40%. So they're looking to raise a lot of income from there. If you're looking to buy an electric car for tax savings, which is the only reason I mention it in a business special, is that they're going to be doing a per mile charge, if we ever see this come into law, on electric vehicles from April 28. So you've got to factor that into your numbers. The problem is, how do you factor it into your numbers? No one really knows, right? They're going to be releasing a consultation with little bunny ears that is going to come out, and you're going to be able to see what's happening. There is also, I thought was cool, there was also going to be a entrepreneurship in the UK prospectus coming out. So I'd be interested to see what that's all about. There wasn't much said about it. It was just buried in the document. So there's more on that to come. If you currently invest in VCT, so venture capital trusts, you get massive tax relief. So a lot of relatively wealthy, not necessarily relatively wealthy, but if people are looking to invest their money in sort of high risk investments, sometimes they use these VCTs, and you used to get 30% tax back instantly. So for a lot of people, they worked out quite well, and there was other criteria and allowances that made them very tax efficient. They're dropping that from 30 to 20, so they're cutting some of the relief. Now I think their idea is that if they cut the relief for that, those people put the money somewhere else, like maybe into some of their other seed investment schemes or into other sort of growing UK companies. But if you're in that world, just know you're losing 10% out of that, which is quite a big deal. Now, for more mature businesses, if you're looking to offer shares to your employees, you basically, the criteria of what's known as an EMI scheme, and I could do a whole show talking about this, but if you want to give shares to your employees, EMI is normally the route that a lot of people go down. Still expensive to do, very expensive and administer initially to get going, but it's a government-backed scheme that allows some very favourable tax treatment for the employee, and it just stops instant tax charges a lot of the time. That sort of caps out at a certain level. Now, for most small businesses listening to this podcast, you're never going to reach that level, but they've just increased the caps. So you can be a slightly bigger business and still use them, which is cool. So that's important. Also, if you use EIS, which a lot of startups do who are looking to raise money, they've changed some of the limits. Same with VCTs, things like that. So just larger companies better qualify. Now, if you ever did get to list on the stock exchange as well, they've put in a new 3-year exemption from stamp duty to try and get people to list more in the UK stock market. So, and they're going to continue to look at stamp duty on the shares as well generally, because I know a lot of people who like to buy their shares get annoyed with the stamp duty. So We'll see. And also on selling companies, a lot of people were considering using employee ownership trusts. They were the new fashion at the moment. You could sell your shares effectively to the trust that your employees owned, and you can avoid all your capital gains tax. They're literally halving it. They're saying, nope, you can avoid 50% if you like, and then we're doing something else with it. Very niche, but if you're thinking about employee ownership trusts, you've really got to look at your tax position again because it has changed. Now, on HMRC's point of view, a couple of things changed. There's a new reward scheme for informants. If you fancy stitching somebody up for tax avoidance, they might pay you for it. They're modelling it on the US system. More details on that as it comes. You've got more investment into debt management. So they've said this in the last budget. They're continuing to mention it. They're going to put more money into their debt collection department, so you should expect increased collection activity. They're also said they're going to have a new tax debt strategy. They're going to publish and say what they're going to do. So we're going to keep an eye on this because that could change how the HMRC currently collect debt and have an impact on struggling small businesses. And then they have continually stated that they're pushing for digital interaction. And I worry about this because the back end of HMRC systems are not good for digital at the moment. They're getting better, of course, but they're a real struggle. And a lot of our interactions are trying to get those things sorted, but they want to make 90% of interactions digital by 2030. That's a lot. So they said at the budget, the government is announcing reforms to simplify reporting requirements and improve HMRC's services, and will set out further reforms to streamline the process and improve the taxpayer experience in spring 26. So we might hear some more stuff that they're looking to do. We're going to keep an eye on that. Now, the other thing they did say is there was this random one line that said that the government's also taking steps to ensure that self-assessment taxpayers pay tax automatically via regular payments throughout the year. So that most people, most business owners are paying self-assessment payments, and they're saying that there are steps to ensure that they pay automatically via regular payments. Now, I've not heard of anything on that. I don't know if they're just alluding to the fact that they're encouraging people to sign up to direct debits, because you can contribute all year round. It might just simply be that, but it was a line in the budget. So the other things that didn't get talked about in the budget really was that there was a lot of talk from the government, and even in the speech they're moaning at the Conservatives for not reforming some of the problems of the tax systems, like you get a 60-odd% tax rate effectively at certain points of your income levels just because of the way the allowances just fall off a cliff. And they just criticised the previous governments, but then have done nothing really to fix it. All they've done is tinker around with rates, so we didn't see any real reform at all. So sadly it's that. So I think for me, the summary is if you're an employer, a landlord, limited company owner, then there is bad news all round. If you're in self-employed, so sole trader, or you're in a standard partnership, you seem to be left alone. So you've still got quite attractive rates, at least in today's money. And look, in my experience of working with clients, the best defense is always going to be making sure you've got a decent, profitable business so you can react to these changes as they come. So keep an eye, won't surprise you to know, keep an eye on those numbers and see where you're at, and just track your profits and see how these changes are going to impact you and work it out. Obviously, if you need support, where a decent accountants are, and, I've got a very biased way of saying, by all means, get in touch. So that's it. That is the budget 2025, the main highlights as far as I'm concerned. Now, if you have enjoyed the show, please do subscribe via your favourite app so you don't miss an episode. You can also review us, give us a couple of stars or whatever, hopefully more than a couple, maybe 5 would be really nice. It helps with the visibility, so thanks for everybody that's done that. If you can, if it allows you to, drop us a few comments as well, that'd be great. As a reminder, we have a YouTube channel just for the podcast, so if you just search HeelanHub in YouTube, we've just started throwing these up. I just record them to camera now and they go up there, so you can also comment in there and we'll reply so that you can ask questions and interact. It's really nice to speak to people, so do that. For more business insight and tax tips, be sure to connect with me and my great team across all the social media channels, including, of course, LinkedIn, Instagram, YouTube, TikTok, Twitter, Facebook, wherever, basically. You can also sign up to our 2-weekly HeelanHub Herald, which is an email direct to your inbox. So, for example, right now we've just done this entire budget show I've done has been sent out in a review, so you can kind of see step by step how it might impact you. And if you want to sign up for that newsletter, all you've got to do is go to HeelanAssociates.co.uk, scroll around for a few seconds and a pop-up will be up. If you do want to get in this digital world, because we've said all the different things that are coming digitally, I would recommend Xero. It's still, for me, the market leader and the clients tell us it's the one that they enjoy and the most and find the easiest to use. You can get yourself a great deal by going to HeelanAssociates.co.uk/Xero. I think at the time recording there's a crazy 95% off or something like that. And if you do want to get in touch about anything about the podcast more specifically, you can do so at info@HeelanAssociates.co.uk. That's it. Have a profitable and tax efficient couple of weeks, and I'll see you in the next one.